Will companies successfully pass along all these higher costs? My next guest says yes, and that it's a very good sign for corporate earnings. Joining me now is Barry Knapp. He's the managing partner and director of research at Ironsides Macroeconomics. Barry, it's good to see you again.
Welcome back, Kelly.
Thank you. So what's interesting about this is usually you think, well, everybody can't raise prices because the money has to come from somewhere. And you say in this case that money's coming from extra savings, stimulus checks. I mean, you think consumers are going to pay up everywhere they're being asked?
Yeah, absolutely. I mean, listen, the business cycle pattern typically is that prices paid move first for producers. Input costs, commodities are freely traded. Then prices received move, and then margins catch up. And part of it is because as revenues go up, they cover their fixed costs, not just the variable costs, right? So the prices paid versus received is a variable cost argument, but seeing total growth or total revenue growth up is when they start to cover those fixed costs and that spread widens. That's a big positive for small caps, for example. So this is just a typical business cycle pattern, but specifically about whether consumers will pay higher prices or not.
Right.
They've been paying those higher prices for decades. Service sector inflation, which is 2/3 of consumption, has been running well above 3% through this entire disinflationary impulse. The disinflationary impulse has only been through goods prices. That's a function of globalization, the global supply of industrialized workers going from 750 million in 1990 to 2 billion by 2010. That's the piece that I think is ending,
That's
right? I mean,
well, so let me stop you right there because this is fascinating. Because on the one hand, what you're saying is that, if I'm a company, I should always be raising prices. I mean, you make it sound like there's never been a price hike a consumer, balked against. And I guess what your point is that that's because, broadly speaking, you have Amazon and all these disruptors coming in and generally lowering the price and improving technology. And I take your point, but I just don't know if that's true in the real world. I mean, is it true that I'm going to still happily walk into that Chipotle where we can quote what they just said the other day about pricing? And I look at, the fast food index. I've talked about this before. You go to Wendy's, you can't get out the door for under $10 for like one or two meals. I mean, at some point, aren't the consumers going to find some way to substitute in a way that could hurt profit margins?
Well, as I said, those service sector prices have been rising at that level for decades, right? They never fell. The only time that service sector prices have fallen below 3% is during the pandemic, and that's the whole substitution pattern. But that'll recover quickly. I mean, that's a function of housing and medical care costs that have come down so much. It's really the goods that's where the impulse has come from. And even if you think about, okay, so Walmart, went to China, got a bunch of cheap goods, Amazon disintermediated the goods sector. You don't really get cheaper prices on Amazon anymore than you get from walking into a store.
Agreed.
You get a convenience yield. And that's the broader point, is that goods disinflation from that massive supply of cheap labor in the rest of the world is dissipating, right? That cheap labor supply is gone. Right. So as you restructure global supply chains from just in time to just in case, that you won't get that disinflationary impulse through goods.
Shepard Smith here. Thanks for watching CNBC on YouTube.